Welcome to Chapter 18, Part 2, Social Insurance. And in Part 2, we're going to be discussing unemployment insurance. So unemployment insurance is a program that I would say is both federal and state-based. So the federal government contributes money to it and the states contribute money to it. However, it's funded through a payroll tax. So that is paid by both the employee and the employer. So these programs are going to, just like it sounds, if you become unemployed, you will receive a cash benefit on a weekly basis, but you have to be unemployed in a way that wasn't you quitting. It has to be involuntary unemployment. So what that means is you were laid off, most common. You were fired in some cases. Your position was eliminated, things of this nature. So now, but this has to also be determined. You have to apply for it, and it has to be determined that you're eligible for unemployment. So just not 100% of people separated for their jobs will receive unemployment, but the majority of people will. And it's paid during various periods, depending on what the current laws are. For example, traditionally it's usually 6 months, but in times of economic crisis, that could be expanded to 9 months or a year. Now, so the applicants are encouraged through local employment offices to find jobs. So when you are on unemployment insurance, you are expected to be looking for work and be able to work. If you're not able to work, you need to go on disability. So if you're able and looking to work, you can stay on the unemployment payroll. And this is to help stabilize the economy during times of recession. So during times of a crisis or a recession where a great many people are laid off, this will help stabilize the economy and the shocks to the economy by having so many, millions of people without jobs not bringing any income in. Now, it's extremely crucial for an American economy where a vast majority of people at the lower end of the wage scale, who are most vulnerable to be laid off, are living on a week-by-week paycheck. So having disruption in unemployment could cause them to default on their credit card loans, their car loans, their home loans, their rent, things like this. So you can see how disruptive that could be to the economy, and the unemployment is meant to stabilize. And it's another program that was developed from the Great Depression. Okay, so most everyone is covered by unemployment benefits. So it's something that all private firms and public companies pay an unemployment tax. So to be eligible, an unemployed worker must meet the following monetary eligibility requirements. They have to earn qualifying wages in employment during the base year that they apply. They have to be, like I was saying before, willing and able to work, actively looking for work, and meet a specific waiting period. Now, so this can vary a little bit between state by state, but they want to look at to make sure that you have been working for a significant period of time before you're eligible for unemployment. So you can't just start your first job, work a month, and then claim unemployment. So most states are going to require at least 2 calendar quarters during a base period, which is 6 months. And this is to limit benefits to workers who are currently long-term engaged into the workforce. Now, when an applicant is on unemployment, they're expected to be capable of working and ready, willing, and able to work. And they must be actively looking for work. So the programs will usually have some sort of weekly survey or interview where you need to respond to questions about have you looked for work, things of this nature, to make sure that you're putting up a reasonable effort to obtain work. They don't want unemployment to become an extended vacation for people. So it's very much encourage that you continue to look for work and not just rely on unemployment while you have it. Now, you're not required to take any job you don't want. However, if you refuse suitable work without good cause, this could disqualify you for benefits. Now, it's very unlikely that they'll know that you refuse to take a job because it's not reported back to them, but it is a stipulation that you need to agree to. And the suitable work generally has to be some kind of occupation that meets safety, health, and labor standards. Typically, for most programs, there's a 1-week waiting period that has to be satisfied, depending on the state you're in, before you can receive benefits. Now, also, if you have 2 jobs and you get laid off from one job, so you have a full-time job and a part-time job, and you get laid off from your full-time job, this could limit or eliminate all your unemployment benefits. So that's an important thing to remember. Now, applicants also must meet non-monetary eligibility requirements. So for example, things that could disqualify you from certain unemployment benefits is that if you voluntarily quit a job without good cause. So you're not entitled to receive unemployment if you just up and quit the job because you don't like it. Refusal to work without good cause. So if you're refusing to go back to work just because you want time off, that could disqualify you for unemployment. If you're discharged due to some sort of misconduct at work, due to some sort of breaking company policy, then that could disqualify you for unemployment insurance. Inability or unwillingness to accept full-time work if it's offered to you, and unemployed because of participation in a labor dispute. So if you have a labor dispute and you become unemployed because of that, that could be grounds for disqualification. But it's very rare, and this also depends on state law for specific reasons for disqualification of benefits or postponement of benefits. So you need to check with your current state to see what the current rules are for that state. Now, regular state benefits, remember, each state is different, but states are basically going to look at what your past wages are. So the more you made in the past, the more your weekly benefit will be, up to a certain limit. So most states will have a formula, for each program. So a weekly cash benefit is paid for each week you're on unemployment, and the benefit paid, is going to be it's going to be a certain minimum that everyone will get no matter how much you make, and a maximum that you will get depending on the formula and the size of your salary. But it's generally going to be, say, a quarter of your wages or a fraction of your wages. And it could be, all depending on how you fit into it. So, for example, if you're in New York and you make, $1,000 a week, you're going to likely receive $500 in unemployment insurance, 50% of your income. If you make $2,000 a week, you'll still only receive $500, which is currently the maximum in New York. Now, this, of course, this program can be adjusted. Typically most states will only pay out for 26 weeks, but there can be an extended benefits program due to some sort of economic crisis that is creating an economic recession. So sometimes they do extend benefits when you exhaust your regular benefits, but that's not always the case. And in some cases, they have additional money that will add on top of the Fed government can add on top of the state levels. So, for example, there was a situation where, due to a medical situation, a financial crisis and recession was created. The federal government stepped in and granted an extra $600 of weekly unemployment insurance for a set amount of weeks. That ran out. Then the government reenacted a temporary extra $300 for a set amount of weeks. That ran out. The recession was still occurring. and they granted another $300 a week. And usually this runs anywhere from 5 to 13 weeks, depending on how long the Congress wants to set those additional unemployment compensations. So that would be sort of emergency economic conditions. So if we're talking about emergency unemployment compensations, this is what we were just talking about. So if there's an economic crisis, the federal government or states can enact some emergency unemployment compensation, as it was done in 2008, 2020, and so forth. 2021, so you get the gist. Now, hold on. Okay, so let's talk about how the programs are financed. So state unemployment insurance programs are financed by payroll taxes paid by employers on covered wages by employees. Now, depending on the state, though, there's some states have minimum employee, also require employee contributions, but not all states. So in some states, it's a combination of the employee and the employer contributing to unemployment, and in some states, it's just the employer. So it depends on the state you live on. Now, the contributions are deposited in a federal unemployment trust. So each state has a separate account, and it's, in good times, this account generally grows and becomes bigger and bigger in good times, and fewer people are unemployed. But in economic recessions, these accounts get tapped into and drained pretty quickly. And each state has their own account with the federal government, so the larger states have bigger accounts and bigger liabilities compared to the smaller states. And some states, could their maximum unemployment insurance, I think states in the South, some of them are $166, $200 a week unemployment insurance. So for some states, the compensation is very little. In other states, like New York and California, the compensation is a little bit more generous. So for the Federal Unemployment Tax Act, going back to 2018, covered employees and employers to paid a federal payroll tax of 6% for the first $7,000 of wages for each covered employee. So this would be the employer would pay the 6% of the first $7,000 of wages. Now, covered employers can credit towards the federal tax at any time contributions paid under the approved unemployment insurance program and any tax savings under the approved experience rating plan. So these are different plans they have within the law. We're not going to go into extreme detail of those right now, but in 2018, the strengthened reserves, most states have a taxable wage base that's going to exceed 7,000. So even though 7,000 is a base amount of 6% of the first 7,000, most states are going to have a wage base that's going to go beyond 7,000 to properly fund their accounts, especially if the states are more generous in what they pay out and the unemployment insurance. Now, the total employer credit is limited to a maximum of 5.4%. So the remaining 0.6% is paid to the federal government and used for state and federal administration expenses. So there is a cost. Running this program needs to be covered by part of those taxes. Not 100% of the taxes go into be returned as unemployment compensation. Now, so states can basically borrow from the federal government to extend their accounts if they get depleted during an economic recession. So if a state depletes their unemployment insurance account, then they'll be able to go to the federal government and be able to borrow money to fulfill their obligations to the citizens. And then when times get better, they'll pay that loan back to the government and start reaccumulating their unemployment base insurance account. Okay, so let's talk about some problems with unemployment insurance. Okay, so there's a couple of problems here that we want to talk about. One, programs do not cover all unemployed persons. Benefits are inadequate, and a high percentage of claimants are exhausting their regular state unemployment benefits. So let's talk about a small amount of people, small proportion receiving benefits. So some state unemployment compensation programs, they're not going to cover all people. So there are various methods exist for measuring proportion of the unemployed who are going to receive the regular state benefits. So one common measure is the recipiency rate, which is going to measure the amount of the percentage of insured people versus percentage of the total unemployed. So we can figure out the amount that's going to be receiving benefits. Now, low recipiency rates are due to several factors that could cause this. Most of it's the state interference. So the state adopts tighter eligibility requirements. So in some states, it's harder to get unemployment than other states. Now, the more restrictive policies will deny more people their benefits, have longer waiting periods, and it's all meant to just be a little more strict with the types of people that can receive unemployment. For example, in some states, if you're self-employed, you can't receive unemployment. And if there are certain professions you're in, that if you're not a regular employee, even though you're working, you can't receive unemployment benefits. So that is something that was looked at closely, and during the financial crisis of 2018 to 2021, some of those, the federal government stepped in and clarified that some categories can now receive unemployment during this extreme financial crunch, such as self-employed people. Another big problem is the inadequate benefit that people receive. So hopefully you receive a 50% replacement rate of your income, but not all people will receive 50% rate depending on how much you make and what state you're in. Now, this is a problem because the government is going to expect that you can supplement the other 50% of your pay through savings or some other means. And for most people, they can't do that. So, for example, the average weekly wage in the United States is close to $900, but the benefit payments are closer to $400 currently. So you can see that for most people, that's not going to help them. They can't live off of that if they didn't have prior savings. That's why it's always important to save 10% of your salary to help supplement in case you are unemployed. And depending on the state, some states are less generous, some states are more generous. Odd thing occurred during the 2019 when for the short period the federal government was giving $600 extra a week. Some people actually wound up making more on their unemployment insurance than their regular wages. So, you could be taking home $1,100 a week if you got the maximum New York amount of $500 plus the extra $600 from the federal program. And that $1,100 could constitute more money you were taking home prior to being unemployed. And it's also deceptive because when you receive your unemployment insurance, it's not taxed when you first receive it, but you will have to pay taxes on it at the end of the year. So for many people, if they're on unemployment for a long period of time, they might actually also ring up a hefty federal and state tax bill at the end of the year that they may not realize during the year because they're not currently going to be taxed on that income. And the question came around saying that if people are making more on unemployment, why would they want to go back to work? It's a disincentive. So that was also a concern for a while. But those funds were quickly expired and went back to regular state funds. And those questions disappeared. Now, there is a high rate of the funds, being completely exhausted during a recession, especially particularly harsh recessions like in 2008 and 2020, 2019. So you're having a high amount of people applying for unemployment insurance. This is going to exhaust the amount of money in the reserve, and that that could be a strain, because the states are going to eventually have to pay that back at a certain point, and exhausting the regular funds for the state. Now, for many workers, they may exhaust in the regular times. If they only have 6 months worth of unemployment insurance, if they don't get to find a job before 6 months is up, they'll have exhausted their benefits. In times of financial crisis, the government generally does extend them to 9 months or a year, which is good. Okay, let's switch over now to workers' compensation. Now, it is probably more likely that you'll be disabled or hurt in a job than die during your working lifetime. So workers' compensation is a program that's going to provide medical care and cash benefits and rehabilitation services to workers who are injured or sick due to job-related accidents or diseases. So it's more likely in your working life. First of all, it's most likely that you will not be disabled or die during your working life. But for the few who are unlucky enough to be injured, there's working compensation so that these families don't become financially destitute. Now, some jobs are more dangerous than other jobs. And if you have a job that is dangerous, maybe you do construction work on skyscrapers, or maybe you work in a production facility that, serious accidents could occur. So an employer could have, could have these common situations that would put the employee, make the employee unable to work for a short or long period of time, and workers' compensation would be a way to kind of stabilize the financial situation of that person and their family. Okay, so the employer could use 3 common law defenses to defeat lawsuits from injured workers. So a lot of times, if you're injured, the employer wants to, if they feel that it's not legitimate, they will want to go to court to reverse the workers' comp decision. And for employers, the more people on workers' comp, the more expensive their insurance becomes. But the whole point of workers' comp is to reduce the economic uncertainty if you're disabled at work. However, there's been some abuses of it, so the employers want to make sure that they're not negligent, and they're going to look for workers to prove negligence before they can collect any damages from the company or a workman's comp. So if we look at the contributory neglect doctrine, so this is an insured worker could not collect damages from the employer if he or she contributed any way to the injury. So basically what this is saying is, if you caused the accident, if you put the water on the floor on purpose so you could slip on it so you can collect workers' comp, you're not going to collect workers' comp. Under the fellow servant doctrine, the injured worker could not collect if the injury resulted from neglect of a fellow worker. So in this particular case, if a fellow worker, say, didn't properly unplug a machine, and your hand got caught in the machine and the machine was active when it should have been unplugged and secured, this is neglect resulting from the negligence of a fellow worker. And thirdly, the assumption of risk doctrine, the incurred worker could not collect if he or she had advanced knowledge of the danger inherent to the particular occupation and still choose to work in that occupation. So this is another type of law that basically says, if you going to take an occupation where you feed crocodiles and you get bit by a crocodile, then that was an assumed risk that you were willing to take. So as a result of these laws, relatively few disabled workers collected adequate amounts from their injury because of these 3 laws or doctrines, it made it difficult for most workers to collect workers' compensation. Now, in the enactment of these worker liability laws this goes way back over 100 years ago, there was a step in the direction of workers' compensation. So these laws reduced the effectiveness of the common law defenses, improved the legal position of the injured worker, and required employers to provide safe working conditions for their employees. However, if injured workers were still required to sue their employer for and prove negligence before they could collect on their injuries. So finally, the states passed workers' compensation laws as a solution to the growing problem of work-related accidents. So you could see how at the turn of the century there's, because of these laws and because of the really dangerous working conditions, very few people were able to sue their employer or collect workers' compensation. So, however, in 1908, the federal government passed a workers' compensation law covering certain federal employees, and by 1920, most states had their own similar laws, and today states have pretty well-developed workers' compensation laws with the principle of liability without fault. And when we're talking here liability without fault, what we mean to say is the employer is held absolutely liable for job-related injuries or disease suffered by the workers regardless of who's at fault. So this puts it squarely on the employer. So disabled workers are paid for their injuries according to a schedule of benefits established by the law, and workers are not required to sue their employers to collect benefits. So this was a big change. So in the past, before these laws were enacted, it was very difficult if you were injured on a job to receive any compensation. You would have to try and sue your employer, and the employers put up all these doctrines to prevent these lawsuits from going through. And just the growing list of people who are taken advantage of by these employers helped change the laws to what they are today, which is liability without fault. So no longer do employees have to sue their employer. The burden of proof and the burden of legal actions now would really rest with the employer if they felt that the compensation was not lawful. And now the current law also provides for prompt payment of benefits to disabled workers, regardless of fault, with little paperwork or legal formality. So basically, get paid first, figure out if you're truly liable later. So the cost for workers' compensation is basically considered a normal cost of production that is just going to be something that employers have to pay, and it's part of being in business. Okay, so that was the evolution. Like a lot of laws for employment in the turn of the century, things always favored the employer. Dangerous working conditions where people are trapped in buildings as they went on fire. Kids normally were working in dangerous jobs. And as the society became more civil and more just, these laws were changed in favor of the employee, in favor of justice, and now workers' comp is a program that is very much more functional and fair to the employees. And let's talk now about the overall objectives of workers' compensation. So today's laws are basically want to provide a broad coverage for employees for any type of accident or disease-related event that would cause this disability, entitle the worker for workers' compensation. Now, when we talk disease, there's been many cases where employees were affected by radiation that caused disease, such as cancer, affected by asbestos, which caused cancer, affected by chemicals used in the work process that affected their health. So this is the disease portion of it. Accidents are pretty clear, putting in a dangerous situation where the employee is hurt. Okay. Provide substantial protection against loss of income. So the laws are there that if the worker is injured, that they were going to receive a replacement of income. Provide sufficient medical care and rehabilitation services. So if the employee is sickened or if they lose some bodily movement, there's rehabilitation to help them regain their ability to work. Encourage firms to reduce job-related accidents. develop effective safety programs. So this is something like OSHA, and different programs are in place to make employers, one, have to adhere to a measure of safety at work, follow safety protocols, especially when dealing with machinery, chemicals, things of this nature, and reduce litigation. So the state and the federal government definitely wants to reduce litigation because it's a cost to the state and the federal governments to manage this litigation of workers' comp. So if they could eliminate most of these lawsuits through proper laws and fair and just laws, then that lightens the burden of judicial requirements on the states and federal government. So employers can comply with state law by purchasing a workman's comp policy. So employers have to purchase workman's compensation insurance. They can be self-insured, or they can obtain insurance from monopoly or competitive state fund. So somehow the employers need to obtain this insurance for workers' comp. So most occupations are covered by workers' comp laws. Some states do exclude or provide incomplete coverage to, say, farm workers, domestic servants, casual employees. So it depends on where your classification is. So some states exempt firms with very few employees. If you have less than, say, 10 employees, you don't have to worry about workers' comp. So there are different laws. And again, this is state dependent. So two eligibility requirements must be met to receive benefits. One, the disabled person must work in a covered occupation. And two, the injury or disease must arrive out of the course of the employment. So it can't happen where it was something out of work, you're injured yourself out of work, or you got sick outside of work. You won't be covered by workers' compensation. It has to be happen within the grounds of work. Now, so let me give you the following situations are usually covered under typical workers' comp law. So if an employee is if you're traveling for work, is injured, or engaged in activities that benefit the employer, you're going to be covered. So if you have to travel for work, like say traveling salesman, you get hurt, even though you're outside the work office, you still will be covered. Employees injured while performing specified duties at a specific location. So maybe you work with fixing electric, and you go to someone's client's house, you'd be covered because you're doing these duties for the employer at a different location. Employee is on the premise and is injured going to the work area. So if you're on the grounds of the building, say you slip on ice heading into the building, you have grounds for workers' comp. Employee has a heart attack while lifting some heavy materials at work. So even though the heart disease was not caused by work, but the heart attack was caused by a work activity, you'd be compensated. Now, here are the law provides 4 benefits. 1, unlimited medical care, disability income, death benefits, and rehabilitation services. So the medical care generally is covered with no limitation. So whatever medical care you need will be covered by workers' comp. After you satisfy a specific waiting period, you're going to receive disability income benefits that should be close to what your salary is. Death benefits will be paid to survivors if the worker dies as a result of the accident or disease. And there will be rehabilitation service provided by the funds of the state to help disabled workers regain employment or regain productivity in employment. Okay. Now, let's talk about some special cases here. So the increased use of medical marijuana and its impact on workers' comp is a growing problem to employees. So as more and more states legalize the use of medical marijuana for various reasons, maybe it's pain, there's various medical reasons for this. the increase of this medical marijuana use, meaning that they could be on medical marijuana during work hours, is going to have an impact on workers' compensation because it can impair perception and judgment. So it's sort of a work in process as far as how the laws are currently being written, since it's so new. There are difficult problems. First, there's a conflict of state laws concerning whether work-related injury is, compensationable for injured claimant who's prescribed medical marijuana and tests positive for a drug screen. Also, it's unclear as to whether workers' comp payers must pay for medical marijuana prescriptions for the client if they have receiving workers' comp, and a lack of standard billing practices dedicated to drug utilization. Some states maintain that under federal law, marijuana, of course, is still a illegal substance. This may change in the near future as the federal government may take up and look to legalize marijuana for medical use or even recreational use. But since the federal government says it's illegal, the states can say, because the federal government says it's illegal, even if the state says it's legal, they can say it's a non. If it's related, if the employee is taking medical marijuana, then it's going to nullify their claims for workers' compensation. But other states say that if the marijuana is legal in the state and it's prescribed by a licensed provider, then the injured employee is entitled to take it, and even if it caused the accident, would be able to get compensation for workers' comp, even under that situation. But as far as, the question is, if the employee is on workers' comp, will their new medical coverage from workers' comp continue to pay for the medical marijuana prescription? So these are different things that are currently being worked out as medical marijuana becomes much more common for employees to take, and this could impair their function on the workplace. So this is something that's a new, and it's not new that certain drugs will impair your performance. There are plenty of drugs that can cause people to become sleepy, people to become less acute in their thinking, people to all sorts of side effects, whether it's painkillers or other medications. This is not a new problem related to workers' compensation, but previous drugs have been worked out, and it's just that medical marijuana is new, so it's completely a gray area that states are jockeying to see what their liabilities truly are, and employers, definitely, if they feel that medical marijuana is really the cause of the injuries of the workplace, not the work itself, they may have a right to say that if you are going to consume medical marijuana, you're going to forfeit your workers' comp in certain situations. I mean, it's controversial. I have no opinion on this one way or the other, but it's something that states or the federal government is going to be dealing with in the future. So another problem, like I mentioned before, is the overuse of prescription drugs, such as, painkillers. And this is the Percocet, Oxycontin, morphine are very strong painkillers that generally have strong side effects. And workers will more likely than not have an injury when they're on these strong medications. And many physicians will prescribe these types of medications for people who are in severe pain. But unfortunately, these pain medications are addictive, and addictive to the point where even after the pain subsides, the people taking these drugs want to continue taking these drugs due to their addictive natures. So states have prescription laws to monitor the use of opioids and also other drugs that are could be listed as controlled substances, that prescribers, doctors who prescribe them, are more closely monitored through electronic databases to see if any of these prescribers are over-prescribing or if certain people are over taking these drugs. Okay, so that is Chapter 18. I look forward to talking to you again when we move into Chapter 19, and we'll be moving into the liability risk chapter at that point. Thank you for your time, and enjoy the rest of your day.